Welcome back to Rockstock Channel. It is Thursday, October 3rd. Shana Tova. Happy New Year to all of you who celebrate. I do, but not religiously. So we are here today with Fast Markets. Every day I get an email from this gentleman who doesn't seem to have any vowels in his name and kind of hard to pronounce, but we're going to call him Koralewski. We're having him on the show today because Fastmarkets announced that they're launching a spodumene contract quite soon, and we want to kind of get some color on that. But Fastmarkets had their European event in Amsterdam, and it was just LME week, so we're going to start, talking about that, in a second. But I was looking up when I was thinking in preparation for this video. Back in 2018, 2019, there was all this discourse of, in the LME and the CME kind of put out to bid who's going to be the price group, for an eventual contract. And they were very focused on hydroxide. And I have an interview of myself at the Fastmarkets Santiago conference being asked about that. And I was saying, like, why don't they do a spodumene contract first? Because of our comparison to the iron ore market, and there are just many more tons in the spodumene market. But in any event, Fastmarkets and the CME, I think, launched the hydroxide contract, officially launched 2 years after that interview in 2021. Carbonate contract was launched in 2023. You're now announcing a spodumene contract, and we'll talk about, that could be active in the next number of weeks before the end of this year. We don't know how liquid it'll be, but before getting into that, if you could just give us a bit about, your background, what you do at Fastmarkets, Prez, and then talk about, just some takeaways from Amsterdam event and the current, LME, and then we'll talk about spodumene. And Rodney has a bunch of questions as well.
Sure. Thank you. Thanks for having me. It's great to be able to speak about the spodumene futures and what we've done in the future space in general. So yeah, I don't have too many vowels in my name, but that's what we do in Poland. We make it difficult for everybody. My role at Fastmarkets, I'm global head of market development. What we do is, it's a team that is responsible for a big part of what we do is the financialization side. So we look at what prices are being adopted in the physical market and whether they satisfy the requirements for a financial futures, whether there's a need for financial futures using some of these prices. And then we work with exchanges and the financial ecosystem to launch them. That's a big part of what we do. But then also on the physical side, we work with our pricing teams and editorial quite heavily in order to support the adoption of those prices and really maximize the value that our price and price benchmarks can create for the industry. My background is in the financial sector. So I started in trading, then LME brokerage, then I was at a commodities exchange and made my way to Fastmarkets last year. Yeah, so that's me in a nutshell. In terms of you mentioned the Amsterdam conference. Yeah, I think it was a good turnout. There was over 400 delegates at the conference, which was a similar number to the prior year. It's no secret that the prices are much lower than where they were last year, so the sentiment wasn't as positive. I think there was the discussions were very much around pricing was at the center of many discussions. Pricing and securing supply, really, those were the areas that we had quite a lot of discussions around. And I think, what was definitely different is that there was a lot more attention to the pricing mechanisms and to the price itself and to hedging. And I think that is positive for the industry in general as we look forward. Obviously, we're in this situation that's part of the discussion because there's pain with the current price levels. But we've seen this before. This has happened in other markets. You really get into this discussion when you don't get into the discussion of risk management and hedging and whether price discovery, how it's evolving and how it will evolve. when everything's perfect and everybody's happy and making money. You usually have these discussions when there is something that is not as expected or is not at a level where it should be in terms of the price level. So over time, I think that will be positive, but it certainly has been caused by the pain in the market. So that's the main takeaway, is that we've seen that progression. And when I looked at the notes back from Amsterdam, certainly it was there was a lot of voices around how do we actually learn more about hedging. We want to see more financial counterparts at the events. We want to be able to talk about securing financing for projects. So there was a lot of focus on the financial side this year as well.
Okay, and LME Week is happening, at the same time that China has kind of massively stimulated. We're going to talk about that in our upcoming kind of rock stock recap. But
LME Week this year there's been a lot less junior miners than we saw in prior years. Again, attributable to where we are in the cycle. I think the PBOC announcement and the stimulus in China certainly was part of the topics of discussion. Obviously, it has hit more on the base metal side. Copper specifically was key around these discussions. Lithium hasn't really seen that strong of a reaction at the moment, but anything that is stimulus related could potentially, kind of support that price. However, there's also mixed views on, how effective the stimulus package is, and that's where I think there's quite a lot of debate. There's going to be stimulus. Obviously, they've announced it, but how is it actually going to work? Historically, it was the property sector that was being supported quite heavily. Is that something that can be actually done in the current environment with the demographics in China not exactly supporting more kind of construction or more housing? So I think there's a lot of questions around it as well. Not just full risk on attitude, and even some of the discussions at the LME dinner, I think that kind of pointed to that as well. Is we saw quite a bit of positive price action in the metals, but there are some traders that are expecting a bit of a pullback even in the base metals, purely because maybe the market overreacted. That's we'll see that in the coming weeks and how that kind of evolves. But there are mixed views.
So, all right, that makes sense. That in a down market, everyone's like paranoid about price in Amsterdam. You were saying, but one bright spot, I guess, for you and the CME is that there's been a huge increase in volume in the hydroxide price contract over the past year. So it's been it takes a while often for these contracts to kind of get going, but there's a lot of liquidity now, it seems, a reasonable amount of liquidity, and it's been increasing. Could you talk about, and maybe you could we'll flash up, what the forward curve looks like, what the volumes have been, and who are the major players in it? Are these actually producers of spodumene, developers of spodumene? Are they traders, speculators? Like what's the mix? And also, how far out can you hedge? Because we're hearing some producers are, maybe can go out 12 to 18 months with some liquidity, which, can enable, some financial tools that haven't been available last cycle.
Yeah. Starting from the performance of existing contracts, I think, they've been performing very well. The trajectory for lithium hydroxide in the past year has been quite impressive. And typically, if we want to have a look at what how well are they doing, or what the future of these contracts is, we want to see if there's anything that we can compare it to. So, looking at iron ore, we're actually following a very similar trajectory in the first years of futures trading in iron ore on that was on the Singapore exchange. So it's actually tracking a little bit stronger in terms of performance marginally. The lithium hydroxide contract. September was the highest volume month on record and was also the highest open interest month on record. So both of these metrics are very important from a health of the market perspective, and both are at record high levels. So definitely very strong growth there. Liquidity is increasing, so that means that it's easier to execute greater size, greater volumes. But the exchange on exchange volumes are only really a portion of the entire kind of derivative space. So you have a lot of OTC trades that are bilateral trades, typically between a bank and a commercial, and that size that is more difficult to estimate. But there's also hedging in the OTC space. So the overall kind of outstanding or notional amounts of derivatives will be higher than what we see on exchange, because the banks will manage some of that risk on the exchange, but we'll also have some of it purely on their own books. So that's one thing. The current you can hedge out forward lithium hydroxide. Well, it depends on what month of the year we're in, because ultimately it's the current year and then the next 2 years. So in January you're going to have really 3 years forward, and in December you will have 2 years forward before that additional 12 months of contracts are added, because the curve is extended at the end of the year. And this will be the same with the spodumene future. So we'll have the current calendar year plus 2 consecutive calendar years. So that's the length of the forward curve. Now the question around extending the curve, it's not difficult from a technical perspective. It's not difficult to add those listings. Where the challenge is to make sure that there's enough counterparties that are willing to price that part of the forward curve, and that there's demand for it. So I think between the commercial players actually asking for it, looking to hedge that out, and the other counterparties in the market being willing to provide the other side of that trade, that's really where you kind of need to kind of strike the balance and see that pick up before you start adding those additional contracts. Some of the other battery raw materials we have longer forward curves, and that's the cobalt contract, as an example, has a longer forward curve. It's an older contract slightly as well, so that can contribute to it. But we do expect that if there is demand and the sufficient liquidity continues to build up, that there will be an extension of forward curves. It's very much driven from the market.
Probably a good time then to ask the question about who determines the initial margin and margin calls, because I guess lithium being in early stages, it's cash settled. In case it runs hard one way or the other, who determines those numbers?
Yeah, sure. So on the initial margin, it's a model. It's a financial model. It's an algorithm. It's built into, at CME it's called the span. I'm not going to go into details, but it's very much scenario based, and then the derived number and they look at volatility, historical volatility of the underlying. So in that case, that would be the spot price that we supply to as the financial settlement for the contracts. And then it's run into a model, and that's how the initial margin is calculated. And the initial margin will be typically a percentage of the value of the contract. When you ask about margin calls, it really depends on the volatility of the underlying. So it really a margin call is, some customers will have margin calls, others won't. But really, the question here is variation margin. So that means like how much change. The variation margin is what basically determines the day-to-day mark-to-market change of existing contracts. So how much it changed versus yesterday's settlement price, if that makes sense. And then if you have collateral deposited with your clearing member and you're on the wrong side of the market, so it's running against you, you may be called if that deposited amount of the collateral held with the clearing member is lower than the mark-to-market change, so the daily change in the value of the position.
Riz, I don't know if I can't remember if you answered with how it asked. So is it typically banks that are trading on the exchange?
So, I mean, there's a number of different counterparties, and actually there's a report that is published for U.S. exchanges. It's the commitment of traders. report by the CFTC where you can see the breakdown of types of counterparties into different categories. So you have one category is commercial, another swap dealer, you have managed money, and other reportables. So you can get a kind of indication of what types of counterparties trade. And it's a mix today. What we see is that there are commercials, there are, and a commercial can be a producer or it can be a consumer. And then there's the swap dealers. So swap dealers will typically be banks that will have an OTC with an underlying customer, so a trade that is bilateral with the customer, and then they kind of manage that risk on exchange. So they kind of back it, or they hedge their own position that they have exposure to in their books. And then managed money will be more of the speculative kind of hedge funds that are involved in the space. And other reportables is a category that basically says if you don't fit into any of the three other categories, that's where you're going to be sitting. And that could be firms that are customers of a member that is not a direct member of the exchange, but uses a different relationship to access the exchange. So there's a level of separation. It can be that there's a level of separation between the end user and the clearing member of the CME, as an example, in this case. So that's that's a pretty long answer, but it's diversified, and you need diversification because ultimately, if you have only the physical side, you're always going to have an imbalance. Like at today's prices on in either extreme, there's always going to be the physical market that will be, that one side will be eager to buy, the other might, though at today's prices will be eager to buy, but there might not be too many sellers. That's where the speculators come in, and speculators have a bad rep, but there really are liquidity providers, really, and they are much needed in markets that are picking up and that are illiquid, because you just won't get that physical participation to begin with.
On the commercial side, for the hydroxide contract, do you have any sense of, are the commercials trading for hydroxide, or are they actually trading spodumene and using, some ratio hydroxide to spodumene for the contracts?
Yeah, so that's something that I wouldn't necessarily see. If I was a spodumene producer and I was using the hydroxide, then yeah, I mean, I would kind of probably look at it from a ratio perspective. But then again, it all matters of size. So how much spodumene do I produce? How much do I want to hedge, and how much, on an LCE basis that is, because ultimately then that defines, how much participation I will have on on the hedging side, whether that's OTC or on exchange directly. So I guess it's a slightly difficult question because it's not going to be uniform across the participants. And there's not only spodumene traders that are trading this contract, right? I mean, I would say probably there's more of the participants that have exposure to lithium itself, that from a commercial angle. Now, if you think about who actually was first mover and how this started, it was very much the OEM kind of interest that was the first commercials to really start using these futures contracts. Well, they were behind the liquidity that appeared in the futures contracts, because ultimately, typically an OEM would have a relationship with a bank and wouldn't necessarily access the exchange directly, but then the bank would come to market, right? So I think they were the first movers there, and producers kind of came in maybe a bit later. With the spodumene futures, we do hope that there will be a tool that producers now will have a direct tool that will be closer to what they produce, or will be actually what they produce, and that will encourage them to use the futures or any risk management tools, whether that's OTC swaps or with the banks or the exchange futures themselves directly. We do hope that will trigger their involvement. And I think even from a governance perspective, like many of these companies are publicly listed, so they need to go through approval process to actually put a hedging program in place. It's much easier, I think, to demonstrate that, okay, our product is spodumene, there's a growing physical spot market in this space, that now there's a spodumene futures contract. So it makes sense for us to kind of look at how we manage at least maybe a portion of our risk, because not every producer will want to hedge all of their exposure. They actually want exposure to price volatility often, but that doesn't mean they have to have all of the production exposed.
And Prez, you've got an existing pricing on the CIF China 6%. Was that obviously hugely helpful in the groundwork to being able to launch this contract so quickly?
Yeah, I think, what we saw earlier this year is that, well, actually probably even last year, we did see that there was a drive especially from the Western Australian miners, to kind of support that standalone outright spodumene price. And when we saw that, we already had a C6 price that we were assessing. We kind of looked at, okay, how is that liquidity increasing? What are we capturing? At the time, we were not assessing it on a daily basis, so it was published less frequently than daily. But when we saw this signal from the market that there's support for an outright price, that's when we kind of evaluated whether it's ready for a daily price, changed it to a daily price. We saw that liquidity supported the move, and that it has grown quite significantly over the past few quarters. And ultimately, that allowed us to demonstrate that the contract is ready from a liquidity perspective to list on exchange. And that's when CME agreed, basically did their own analysis and decided to launch the contract. So yes, it was helpful that we had it, but it was very much the evolution or the change in the landscape, especially when it comes to spot pricing of spodumene in the past 3 quarters, really, that had led to the situation where we were able to kind of propose the spodumene futures and list it with CME.
And with the contract being cash settled the same way with the CME contracts versus the GFX, which is physically settled, how is the cash settlement likely to impact or create a different level of involvement from speculators versus hedges versus banks, in your view, participating in the contract?
Yeah, that's a great question. And that's a question that we really try to answer in pretty much every discussion that we have around using the futures. Cash settled contracts are very much a reflection of the physical market. Ultimately, our price, if it's used in physical contracts and it's provided from the basis to create these prices, are contributors from the physical market, then it is a reflection of the physical market, and then that's why it's used in the futures, because otherwise it wouldn't. If it was disconnected, there wouldn't be a futures market that would be supported. So I think it doesn't necessarily need to be a physically settled contract to be connected, and the kind of convergence principle of futures to spot pricing to hold true. Whether it has an impact on participation, I think to a certain degree, potentially yes. I think the fact that a cash settled contract doesn't mean that you might end up in a position where you need to either take delivery of physical goods or provide that, might make it easier to approve from a risk perspective, and allow participation for clearing members customer. They still need to go through a lot of kind of risk processes, and it's not as a very easy checkbox, but the fact that there isn't that delivery risk might make it might make it a bit easier in certain cases. But again, this is like going back to the point I made around the different types of participants serve a purpose, and I think it's really important that we acknowledge that liquidity providers are often ones that are critical, especially in the early stages, and they don't always have the physical exposure. So it's important that the market structure supports that as well. I don't, yeah. And if we look at some successful cash settled contracts, again, we're going to go back to iron ore. Iron ore is a cash settled contract on SGX and trades at 4 times physical market today. So, that took, close to 15 years to develop to this level, but it's a liquid market, and it's used for hedging purposes, for investment purposes. So absolutely, I don't feel that there's any kind of downside to cash settled contracts. It's an innovation in this space, but it has proven that there are successful contracts and that serve the purpose of hedging and both investments.
And on that note, because there's a strong correlation between spodumene prices and hydroxide and carbonate prices, do you think that the introduction of a spodumene contract could actually boost the volumes of both over time, because you can trade, you can arbitrage between them, you can do all sorts of things? Do you think that is that a likely outcome?
I do think so. I think that spodumene, even though it's correlated, there are times when those correlations break down. And we did see those correlations break down quite significantly at the turn of the year and then into the first quarter, even second quarter of the year. So that creates basis risk. And not every many sophisticated traders are comfortable with basis risk, but not everybody is. So I think there's certainly an opportunity for, new entrants, but then also trading the spread is 100. If there's volatility in the spread and correlations break down, then that is something that creates opportunities to trade one against another. If they were basically one-to-one correlated the entire time, then maybe less so. But those correlations break down, and if we look at that spread, it can be quite volatile in itself. The positive thing is that if you trade the spread, the exchanges actually apply something called basically a credit on the initial margin. Yeah, exactly. Because if you have, if you're trading, if you're, let's say, long spodumene, short lithium, then because it's correlated, there's less risk in terms of if the market moves up or down. You would have both of them move in the same direction, maybe at a different pace. So you get a discount to the initial margin. So it becomes cost effective as well from that perspective. So I do think it will help. I mean, the lithium hydroxide and lithium carbonate, there's a higher correlation there. And we have seen some activity actually between the two, trading that spread as well between the hydroxide and carbonate at times. So if something is less correlated, I think it actually there will be a segment that will try to take advantage of those price movements between the two. And again, this also provides opportunity for, let's say, the non-integrated converters. That kind of helps them manage their conversion margin. So ultimately, the short answer, I do think that it will help liquidity for both spodumene and hydroxide.
And in terms of
it's really up to the industry to see how they use it, right? I think there's also the question of liquidity. Some might want to continue use hydroxide and kind of like as a percentage basis and adjust it on a dollar value as opposed to like use the spodumene or the futures. But the tool's there, and it allows the market to evolve in the direction that it wants to evolve.
The sort of origination and idea around the contract, were you approached by the various market participants, or was this driven more on?
Yeah, that's also a good question. I think part of the very interesting part of being part of this evolution of a market that is still quite small but is rapidly growing is that there's also, you see what worked in other markets and what has the potential to work here, but the education piece is not it's not as educated, it's not as sophisticated yet, this space, as other more mature markets, naturally, because you need to get to that level. So we saw the signals, and we had conversations with the market whether something like a spodumene futures would make sense. And depending, it's rarely 100% yes, I'm all for it, or it will help us in every aspect. depending on what type of counterparty you are, you might have some, concerns because you might be thinking about splitting liquidity. The other side of the market might say, yes, we need it because it better suits our, production. So to answer your question, did we have people come to us? Well, we heard that the market needs transparency, and we heard that the market has challenges in financing. And this is the way that we then propose to solve at least part of that problem, and going forward, maybe a bigger part of that problem also when it gets more liquid. And once we started discussing this, then we did see that there is support. And when we bring this idea to an exchange, the exchange also does their own due diligence. So they do speak to the market participants. They try to understand who's going to be there, who's going to support this. Exchanges don't really want to list futures contracts that end up not having any liquidity. So they do go out to the market, and I think the fact that it has been launched demonstrate that they've also assessed that there is going to be support from the industry for the futures.
And then last one from me, Prez, what would success look like to you with this contract, going forward in a year's time?
Yeah, great question again. And I think Lithium took 2 years to really start trading, right? Launched in 21, 23, we started seeing sustainable volumes, daily volumes on the exchange. I think if we, in the first year, if we start seeing, I would say, working orders and continuous volumes in the market, then that would be a huge success. And if I was to put a number on it, I mean, it's very difficult to put a number on it because of all the different dynamics at play. But what I would want to kind of look at is like, yes, how the forward curve is shaping, and then what is in terms of volumes. If we get to 4% of the volumes on exchange compared to the physical market, and that's actually what we saw in the second year of Lithium, then that would be a huge success. That would mean that we're already kind of tracking at the same kind of dynamic when we look at derivatives to the physical market, but at a faster pace. And I think that is possible because Lithium was a new contract in a very new space. Spodumene is a new contract, but in a new space still, but already has activity in the derivatives market. So that might encourage traders to be more, to take the leap of faith sooner than with Lithium. So I do think that.
Just to confirm, as a last point, it's the current year and then 2 years going forward that's on it. So when I look at the hydroxide, I see it goes out to December 26. So you've got this year and then 25 and 26. Yeah. And then as of January, you would go out to 27.
Yeah, exactly. That's the roll happens. The additional expiries are generated in the year. Yeah.
Okay, so you would then have almost 3 years effectively from yes. January. Great, thanks.
Yeah, it's basically current year first move. Yeah.
Depending on how liquid it is, I guess, is a question on how real that price is. If it goes all the way out, 3 years, if it's more liquid in 18 months or 24 months, then it's, that I guess determines how useful it is as a risk management tool. I'm just going to.
On that note, just to add to that, just real quick note, different commodities have different distributions along the curve. So, if you look at like iron ore, a lot of that volume is concentrated in the front of the curve. It's actually in the battery, in lithium, we see it more spread out across the curve, which is quite interesting. It doesn't necessarily mean that, just because if there was a 5-year curve and we didn't see volumes on the back end, doesn't mean it's not useful from a hedging perspective. It's just that it might be hedged better using liquid front of the curve contracts, because then you kind of roll it as the expiries, as the contract months expire. So it's a combination of liquidity versus actual price and exposure on that part of the curve that the traders will be assessing.
There's an interesting comment you made that just after a few years, comparing it to iron ore, it's tracking a similar amount of volume, but the volume, the overall tons in the iron ore market are orders of magnitude larger than the tons in the hydroxide market. So you're tracking well above from that perspective.
Well, just to clarify, the metric that we use there is the derivatives volumes to the physical volumes. So it's a ratio of how big the derivatives market are compared to the physical.
Okay. So then it's tracking similarly. It's not okay. It's not the
Not
overall
on
notion.
the, like,
It's not the notional value versus the size of the market. Okay, or the size of the tons.
Exactly.
Okay. I have looking up in front of me yesterday's Fastmarkets price reporting, and I see lithium hydroxide at $9.78 per kilo, and I see carbonate at $11. So carbonate's trading at a meaningful premium to hydroxide, and similarly, on the Chinese currency, 76,500 for carbonate, 69,000 for hydroxide, and then you have spodumene at 810. But then, these prices seemed unheard of and unlikely, and they've been there for low for quite some time. But on the RK Equities scoreboard for September, you had a lot of green on there, and some of that could be China stimulus related, some short covering. We're seeing that the short cover, the short interest in Pilbara has been going down a little bit from 21 to 19%, but we're not yet seeing a meaningful uptick, in spot prices. You're not a price forecaster. You're not part of that, overall team. So I know you can't comment, too much on price, but I guess where are the forwards today? If we could put up the chart, and what's the forward market telling us today?
Yeah, I think so. The forward curve, if we look at the hydroxide contracts, they're very much in a contango. So if we look at the 1 year forward, so that's like SEP 24, let's say SEP 24 to SEP 25, we're looking at roughly 27% contango.
In dollar terms, so what does that mean? What's the hydroxide price? 20% above now? There's $12.
Yeah, it's yesterday's settlement was like 12.7, close to just under 12.70 per kilo, so 12,700, just under 12,700 for SEP 25. Compared to kind of 10,000 where we are today, or 10 per kilo.
A year ago, what was the forward curve telling us the hydroxide price would be today?
So the forward curve is not a forecast, right? So I think that's one of the things that we also kind of need to be very clear about. The forward curve typically is, spot price and cost of carry. There is some, sentiment built into that as well, and it's not always a mathematical formula. But I would be very cautious in looking at a forward curve and saying, okay, that's where the price is going to be next year. It's really what I'd say it is that's the price given today's market conditions. If nothing were to change and it was always only the cost of carry, then that's probably where we would end. That's how much financing and storage and insurance would cost. So that's kind of where it makes sense.
So that's what's built into the difference in price.
Exactly.
Okay, so the cost associated with holding it and financing it. Okay, that's interesting. I didn't realize that.
Yeah, no, that's 100%. That part of what's built in. What you can see also, it is impacted by supply and demand as well. So you do have that kind of expectation overlay, but really that's how the basis of the forward curve will be what we call the cost of carry. It's interesting for like iron ore. It's actually it's a constant backwardation. So the demand for spot deliveries, for prompt delivery of iron ore, brings that front of the curve up, and you see a downward sloping forward curve. We don't see that in lithium at the moment. We did see that at some point when the prices were super high and that kind of close to the peak level. There was backwardation in that forward curve at the time, but that was a very tight spot market, small spot market. So that was potentially one of the reasons behind it. But and then maybe the expectation that prices will fall slightly, but it's not. I wouldn't necessarily I would caution against just looking at it from the perspective of using the forward curves as a forecasting tool.
Okay, I think Rodney. I mean, I'm a little bit confused by that.
Howard, where the forward price is well above the cost of carry. I don't know that that's now. We had that 50% premium at one point over 2 years. So that was definitely, I guess, price forecasting going on.
Well, that was also
flattened now.
I would say that's also, I mean, that's where I pointed that it's not always efficient where it's only spot plus cost of carry, right? So you do have those situations where you're going to have a interesting, maybe steep contango, and traders actually like to take advantage of the steep contango because they know what their cost of holding the material is, and if they can sell forward at a premium of what it costs them to hold that material for that long, then they ultimately will be doing that. And I think that's what we saw. We saw that premium was above even 50% at some point, on a 12-month basis forward. And there was quite a bit of selling on the back end of the curve, which naturally led to the narrowing of or the flattening of that curve. Now we're kind of more 20, 30, 20, 27% premium. So there's different factors at play. It's not purely cost of carry, but cost of carry is really what determines a big part of an efficient forward curve, and then you have other factors at play. And it doesn't have to be supply demand. It might just be that some people don't have access to the market and are not able to provide that liquidity. In the liquid markets, you probably have there's a greater potential for these for the forward curve or the forward curve to be a little bit create more opportunities for trading perspective, which means that there's something in the market that is not priced in as somebody with more information would expect it to be.
Okay, great. Prez, thank you very much. We'll just end, as always, asking you for your favorite music or song that we could put as a teaser to this. What I think is we're going to title this, the futures in lithium is spodumene.
Well, that's a very, very good title. And song. Well, if we're talking about futures, let's stick with futures. So Back to the Future soundtrack, that might be a good one.
Okay, Back to the Future. Okay, that sounds good. I'll find. We can. They had Chuck Berry in there, but there's a Back to the Future.
I was about to say one song I enjoyed in there, Howard, was when Michael J. Fox played the guitar in.
There we go.
Remember that?
Yeah. I think it was Johnny Be Good or something like that.
Go Johnny Go.
Go Johnny Go. Go Johnny Go. Yeah, that's right. Okay. All right. Great. Prez, thank you very much for your time, and look forward to continuing our relationship with Fastmarkets and its analysts and ongoing dialogue in these ever evolving, highly volatile lithium markets.
Yeah, and hope to see you at the next conference that we have coming up. Quite a few.
Always in Las Vegas, for sure.
That's the big one.
Other ones, we'll see.
All right.
Okay. Take care,
Thanks,
Prez.
Thanks, Howard.